Good afternoon, everyone. It is so great to have you all join us today. I'm seeing more and more people join us, so you all are right on time, and we're grateful that you've joined us today to talk a little bit more about debt repayment and different strategies around debt repayment. And if you weren't at our last webinar, I'm going to go over our logistics again just to keep us up to date on them. The first is that we've gone ahead and muted everybody on the call except for us. So that way, hopefully you can continue doing whatever you need to do during this time. Maybe you have a busy office in the background, or maybe you're eating lunch. Go ahead and do all of those things. We understand this is your time, so hopefully you're able to continue doing those things and listening in. But this doesn't mean we don't want you to ask questions. We hope that you do ask questions throughout today. There is a questions feature on the side of the screen, either on the right-hand side or at the top of your screen, depending on how you logged in. But if you could, put in the questions feature for me where you are joining us from today. That helps me to know that number one, you can hear me, and number two, you know where that questions feature is. So if you could just type into the questions feature where you are joining us from today, that way I can see if you are able to hear me and you know where that questions feature is. Okay, getting a couple answers. Boston, people joining us from Somerville. Perfect. Okay, great. Boston, New Hampshire. Wonderful. Perfect. Thank you all so much. You now know where the questions feature is. So you are able to ask questions at whatever point throughout our time together, and we will do our best to answer those questions for you. The presentation is being recorded today. That way you can go back and take any information you may need to hear again and listen to it one more time. We're going to post it on our YouTube channel, but we'll also send you a follow-up email with this information so you have it right in your email inbox. And I do want to mention there will be a survey at the end of our presentation today. So if you would just take a few minutes and fill that out for us, we would be extremely grateful for that. Like I said, my name is Sarah Scruggs. I am the Community Engagement Specialist at Harvard University Employees Credit Union. I'm so glad to be talking with you all today. Migdalia Gomez, the Community Engagement Manager at the Credit Union, will be joining us for the second part of our presentation and will be probably working throughout the chat as well during the first part of our presentation. So we're excited to be here together with you. We would love to tell you a little bit more about Harvard University Employees Credit Union. We are Harvard's not-for-profit financial institution. We exclusively serve the Harvard community and all of its affiliated hospitals, including Boston Children's Hospital. We believe that we have all of the products and services that those big banks have, but we believe we do it just a little bit better. We are able to join you all and partner with you on products and services that serve this exclusive community. And if you have any questions about the credit union or any products that we could offer, we are happy to talk about that. But I also want to let you know that even if you don't reside in Boston or right around one of our branches, as I saw someone was joining us from New Hampshire today, we do have the ability to do everything you can do in a branch. You can actually do that online with us, either through our online banking or mobile app. That includes loans, includes credit cards, includes joining. So if you have questions about that, we're happy to share, and we'll obviously send you more information about that in our email as well. Let's get started on our topic today. Talk a little bit more about debt repayment. This is a great topic to really think about as we are barreling towards the new year, it feels like most days, but we are going to learn a little bit more about strategies, but also we need to figure out where we are starting from. We are probably all in many different places throughout our debt repayment journey. And so it's really important to understand for yourself, where are you starting? This is a great opportunity from one of our partners, Green Path Financial Wellness. They are a nonprofit and they work with folks on really aligning priorities. So if you have many different debts, if you have many different things that you're paying for, it can be difficult to really figure out, okay, where should I be putting my focus at this point in time? And this workbook tells you a little bit more about that. This is really for folks who really want a path laid out for them about what priorities should be coming first and what things may need to be next, or your next step, or phase 2, if you will. So talking about where we are starting from, like I said, it's a different place for each of us, and that's important to note. We have to sit down and look through all of our debts and figure out what do we owe. Because if we have multiple across multiple industries, maybe you have student loans, which are education loans, you have credit cards, you have maybe a mortgage, maybe an auto loan. We have all of these different debts. And sometimes we can forget exactly what we're paying each month, or what the interest is on each of them. So it's really important that you sit down and you make a chart. And I'll give you an example of a chart that we recommend kind of filling out when you first are looking through your credit score, or looking through what you owe. And then, of course, thinking about the credit score, we are going to talk a little bit about possible refinancing strategies for your debt. And so it is important that you know your credit score, because credit score can have an impact on whether you qualify for a lower rate on some loans. So I highly recommend figuring out what your credit score is. And you can have different types of credit scores. That's important to note as well. And you can watch our previous video, our credit score presentation, if you have more questions about your credit score and credit report. Calculating the cost of debt is probably the first and maybe the least fun step of this process, because it really shows you how much are you paying to have this loan. And it really puts it all into perspective. And so this is the chart we were speaking about previously. And this is calculating the cost of your debt, and you're organizing your debt as well through this. And so this example, we just have 2 loans. We're keeping it simple on this example, but many of us have many more than just this. But it's important that you have these specific columns of the amount of your loan, the APR, or what some might call the interest rate. Those are pretty interchangeable, but the annual percentage rate and the interest rate. The terms, so how long will it take you to pay off this loan? And terms are always done in months, not years. It's pretty interesting, but terms. And then your monthly payment. How much are you making payments toward it each month? Are you making the minimum payment? Are you making a little bit higher than that? And all of this will equal out to how much interest are you going to be paying over the life of the loan. So when we talk about the life of the loan, we're talking about at the end of 120 months on this $10,000 loan, how much interest will you be paying? And you can do all of these equations through calculators on the credit union's website. Many different financial institutions have these calculators as well. But this way, you don't have to do all the math. We can help you with that. But it's important to list these out, because this end number, that total interest paid number, can be really shocking at times. And this could be a good motivator for you. Maybe it's a motivator to help you think about refinancing. Maybe it's a motivator to think about paying down some of that debt a little bit early. So then we get into our last column of this cost of debt chart, and that is the total amount, everything you're paying each month on debt, and then the total interest over time on both of your loans or all of your loans. And like I said, this is really here not to frustrate you or make you angry, but this is here to hopefully motivate you to take on some of these strategies we're going to be speaking about. All right, so we've taken care of step 1, and I highly recommend that maybe you take some time this weekend coming up or next week to go ahead and sit down and fill out that chart that we just spoke about, because it is really helpful to get ourselves organized before we even start thinking about the types of strategies that may be best for us. Because if we're not sure where we're starting from, it's difficult to figure out what the right strategy may be, right? So going into step 2 and thinking about a couple of different debt repayment strategies. There are 2 methods that we're going to talk about today: snowball and avalanche method. The snowball method is one that a lot of people like. This snowball method focuses on the smallest amount of debt. So this focuses on the least amount of debt that you hold at the time. Has nothing to do with interest rates. Those are not a part of the snowball strategy. We're just focusing on the smallest amount of debt. And the reason we would do this is because when we pay off debt, when we reach that goal, it is a motivator for us. I don't know about you. I know myself. I am an externally motivated type of person. If I can get myself a piece of candy for doing my homework, wonderful. That's what I'll do because that is what is needed to motivate me. And it's true. I love that external motivation. Whereas with my spouse, it's the complete opposite. He is constantly internally motivated to learn something new, to do something different. And I'm grateful that we are able to kind of balance each other out in that. And so with this snowball method, this helps us reach those goals, those smaller goals. You're making minimum payments on all of your debts monthly. Never forget this step. It is so important that we continue making those monthly minimum payments on all of our debts across the board. But then we make any extra payment we could possibly have on the smallest loan we hold, the smallest amount of loan that we hold. And then when that's paid off, you move on to the next smallest loan. Just like a snowball, right? You're going from smallest to largest. You have to build up a snowball in that way. So once you start paying off those smaller debts, you're going to be more and more motivated to eventually pay off all of your debts. And then we have the avalanche method. The avalanche method focuses on the highest interest of our loans. And so this is really important because sometimes the snowball and the avalanche can be the same number. They could end up being the same loan, right? But this focuses specifically on the interest. The avalanche method will probably save you money over time if you are able to do it. And the reason why I say that is because with the avalanche method, sometimes you can be paying off your largest amount of loan with the highest interest for years. And you may not feel that sense of reaching goals or that external motivation that you see. You may not see that number go down quickly because you're paying high interest on this, but you may be able to save money. Like I said, with this method, you have to continue making your minimum payments. But with any extra payment that you could make, you're putting it towards the highest interest rate loan. And then when it's paid off, you move to the next debt with the highest interest rate. So with each of these methods, they have their pros and cons. With the avalanche, there's a possibility to save additional money. With the snowball, there's the possibility that you're going to be paying it off and stick to the plan because you see that motivation externally. Just another way of putting it, with the debt snowball, you're starting from the top and you're going to focus on the smallest amount of debt. And then with the debt avalanche, you're focusing on the highest interest rate. And we want to be clear, when we talk about making those extra payments, what are we talking about? We have tight budgets, so we may not have a ton to put towards our extra payments on debt. So we want to show you how far just a little bit goes. So this is a $10,000 loan at 7% interest. Our monthly payment on this would be $200. Our total interest paid over the 60 months is $1,858. Okay. So let's say that we upped that payment by $25 a month. Maybe we realize, you know what, I am buying too many lunches out, and I can save maybe 2 lunches a month. Instead, put that money towards debt repayment. And so you put that $25 additional towards debt repayment. The total interest paid over the life of the loan would decrease by about $250. That saves you a good chunk of money for just 2 lunches per month, right? And the terms, it actually saves you 8 months of paying on this loan. So I want to be clear that it not only saves you a little bit of money, it also saves you time. For those 8 months, you'll now have an additional $225 to be putting towards something else that you want to spend your money on, or maybe a different debt. So this is a really important thing to note as well. Let's say you want to stop eating out on every Friday night. So now you're going to cut out dinner out on 2 Friday nights. So now you can put $50 towards your monthly payment instead. Total interest paid, you're lowering it by about $400 there over the life of the loan. And you're cutting out 14 months of paying on this debt. I know a ton of things I would much rather do with $250 over 14 months than pay it to a bank, right? So I highly recommend calculating these out. Like I said, we do have calculators on our website to be able to help you with this. But it is so important that you see the value not only in the total interest paid, so the amount paid over the life of the loan, but you also see it in how long you'll be paying that. Because there are many, many dinners out in your future once you do pay off this debt. I'm going to toss it over to Migdalia to get us started talking about some other options that may be out there for us.
Thank you, Sarah, and thank you everyone again for joining us. If there is anything that we can clarify, please put your questions in the questions panel. We are here to answer you, to be a service to you and make sure that anything that you want us to clarify, that we do so. So Sarah did a great job of just giving us some general information and strategies to consider, and I'm just going to add on to a couple of more. And as we talk about money, we always have to remember that it is personal. So what might work for one of us may not work for someone else. And I like Sarah's example with her husband and herself and just having different levels of motivation. And that is one of the reasons that we like to give a lot of different options, because for some of us, some will stick better than others. So we're going to talk a little bit now of, okay, now that you have an idea of how much money you owe, you have an idea of what's the repayment strategy that sort of resonates most with you, what are some of the things that you can do? One of the things that you can do is talk with the lender, and not, this may not always make sense in your situation, but there are times, and working at a not-for-profit credit union, which, you know, not-for-profit financial institution, as our all credit unions, we're very fortunate because we are able to help our members. Like, we are not in the business of making profit to make profit. We are in the business of helping our members and give that profit back. So we're able to do things if a member calls us and tells us that they're in a tough situation. So I encourage all of you, if you are in a situation that your interest rate is fairly high, and you know, anything right now for a credit card that's in the, if you're carrying a balance, meaning that you're not able to pay it month, pay it in full every month, and the interest rate, your payments are mostly going towards that interest and not the principal, and you have a credit card balance, excuse me, an interest rate that's in the 20s or high teens, that's a great opportunity. Talk to your lender. If you have a car loan and you're paying more than 2% on that car loan, talk to your lender. If you have a mortgage and you're paying anything over 3.5%, 4%, definitely talk to your lender. There are times that they may be able to actually refinance, and I'll talk about refinance shortly, but they may be able to provide you a better rate for your product. And if they're not, then that, you know, okay, I'm not getting the best rate that I can with this current lender. It may be time for me to move on. However, there are situations that, you know, if they can't do an interest rate reduction, if you're in a situation that you need cash flow today and you just need essentially to pause your loan, some lenders will do that. I know at the credit union we have done skip a pay. It's something we did a lot during the beginning of COVID to help our members who needed cash flow at the moment. And what that is, it gives you the opportunity to literally skip a payment, so that instead of my payment being due in November, it would actually be due December. And I'm not penalized for that payment because I've made that arrangement with my lender. For student loans, you have loan forbearances, extensions. So there are a lot of different things that you could potentially do. We don't always know that that's an option. And that's why, you know, we recommend always starting with the lender, starting with whoever holds that debt that you have, see what options are available, and then evaluate them with the other options that we're going to talk about. And one of those other options is refinancing. But want to make sure we're all on the same page as to what is refinancing. We all have different financial backgrounds, and just it could be a little confusing. And refinancing sometimes it doesn't always look the same across all products. But overall, what it is taking a loan to pay off a previous loan. And for some refinancing, you can take a couple of different loans, such as student loans. That's a very popular one. You can take multiple student loans, federal and or private, and refinance them with a private entity. That's extremely common. We do not recommend that at this time because if you do have federal student loans, your interest rate is at 0% temporarily through January. So we wouldn't recommend that because you're not going to get a better rate than that 0%. But with mortgages, if you have a mortgage and you haven't refinanced, it definitely would be worth looking at because you may be able to reduce your monthly payment, or maybe not reduce the monthly payment, but maybe accelerate by paying more towards the principal. So why do we typically do this? Why would we consider refinancing as a debt repayment strategy? Well, the main reason is that most of us will refinance because it will lower our interest rate. And I've been with the credit union for a couple of years now, and I've seen folks refinance. Sometimes with student loans, I've seen people go from double digits to single. I've seen people with home loans go down like 2 to 3%. So it really depends on when you borrowed the loan. If you borrowed the loan, I would say anything over even 5 years ago, take a look. And even if it wasn't, recently, as we all know, we are in a very low interest rate market, meaning that the rates to borrow are extremely low. So even if you had refinanced in the past, that doesn't mean that you can't refinance again. And that's something else to consider. Yes, it can impact your credit score. It can also impact maybe your ability to borrow in the future if you're constantly refinancing. But if you refinance last year and you can do it again this year and save, the benefit may outweigh any potential temporary decrease in your credit score. But other reasons that we may refinance, sometimes we may not do it just for the lower interest rate. Sometimes we may actually keep a fairly similar interest rate and just extend the term. So for example, if I have a mortgage and I'm in a 20-year repayment, I took out a 30-year mortgage and I've paid it off I have 25 years left, but I need a little bit more cash flow. I need my monthly payments to be lower. I may choose to refinance and extend it to 30 years. So I may be adding 5 years. That does offer you a lower monthly payment, but we definitely always recommend doing the math to see how much additional interest that could cost you over the life of the loan. Depending on the amount of the loan and the interest rate itself, sometimes it may not be that much of an impact. Sometimes it will. That's why we always have to run those calculations, like Sarah said earlier, because we just don't know the specifics of your situation. And you don't have to do this by yourself. Lenders can help you with this. With most refinancing, there really is no application fee, no prepayment penalties. You do want to check with your state. I saw that a couple of folks are joining from different states. Some states have different regulations, so some lenders may be able to charge, but in Massachusetts specifically, you don't have these prepayment penalties. We like examples, so here's another one that we have just to show. So for this one, what we're doing is, let's say that you have a loan at 7%, and we're just going to call it a $10,000 loan, and our monthly payment is $200, and it's for a term or a period of 60 months or five years. Remember what Sarah mentioned earlier, in order for us to determine, okay, what's the best repayment strategy? Well, we need to know, what are we comparing? What are we comparing is going to be the cost of that loan or the total interest paid. So for this $10,000 loan at $200 for 5 years, I'm going to end up paying $1,858 to the lender. That is the cost of me taking that loan and carrying that loan, assuming that all payments are on time and this is a fixed loan, fixed interest rate. That's money I could do a lot of different things with. So let's see, what if we're able to refinance and bring down the interest rate by 2%? May not seem like a lot. Okay, I'm saving $11 a month. Again, doesn't seem like a lot, but if I keep the terms I'm keeping the terms for 5 years, so I'm not trying to pay it off faster, but I've already saved a little bit over $500 in that example. And let's go back to those financial goals. If my financial goal was to pay off debt and save for a vacation or save for a home or save for whatever that is, that's an additional $500 that I have towards that goal. But what if we actually keep the interest rate, at 5%, but keep our monthly payment at $200? So if we're comfortable making that $200 payment, there's no need when you refinance to go with the lower monthly payment, especially if you're able to make that payment that you were making before or even increase it. In this case, we're going to save, might not seem like a lot, $100, about $100 more, but overall, compared to not doing anything earlier, we're saving $600 and 3 months. And I like to think about the time, because the time that you like, just picture that, to be done with any debt 3 months earlier. It's like, oh, what a relief, that's done. That is an extra $200 that I have in my pocket every month. That's money, it's just one less thing to consider. You don't have to deal with the paperwork. It's a good feeling to reach that milestone earlier. And that's something else to consider with these debt repayment strategies is the time, because the time does have an impact. And money impacts us, mentally. It can impact our stress. So we want to make sure that we're doing everything we can to make things more better for us. There are times that refinancing may not make sense. So we do want to talk about a couple things to consider. You always want to consider the interest rate. That is, as most people will refinance for the interest rate. That's really the leading reason. You are looking for a lower interest rate. Most people do not refinance and say, I want to pay more. No, that's the key. So as I mentioned earlier, rates are really low right now. Do the exercise that Sarah mentioned. Go through your rates. Take a look on our website. We have, and I'll put it in the chat shortly, but you can see our rates. They're on our website, just to give you a starting point. As you're all eligible to be members of the credit union, but as much as we would love you to be members, we want you to be educated consumers, and just look at our rates. It gives you a good starting point. And go to other companies, go to other financial institutions, and just compare rates and see, okay, what am I paying a lot for my current debt right now? And hopefully the answer is yes, because that means that refinancing may be a good option for you to save you money. The other thing to consider, though, is that once you refinance, you lose benefits. I always joke about, if you lived in an apartment or owned a home, rented an apartment, however you want to imagine it. And let's say that home had a really good dishwasher, had the latest washing machine, it had like the best heating system. When you move to a new place, you can't bring that with you. Like, it's like that. No, that was a part of that house. You can't go back and start using that dishwasher. Like, you no longer live there. You've moved out of that place. The same applies with the benefits of a loan. If you have a, a loan, especially a federal student loan, and you refinance, you lose all of those benefits. So you just want to make sure that you're aware of that. You're going to lose all of those benefits. And it doesn't, especially right now when the interest rates are so low, literally 0%, we don't want you to do that, because we don't want you to lose out on those funds, in that interest rate. And a couple of other things to consider. Look for lower rates. This is the main reason. And I've talked a little bit about this, but I do want to take a moment and go into it a little bit deeper. But personal loans are another option. So if you have debt, and let's say that you have maybe a medical bill for like $500, you have a credit card for $2,000, you have, you name it, a couple of different debts. You could do a couple of different things. One is that you could take out a personal loan, and that money is given to you, and then you do with that money as you wish. You can pay off those other debts. You can also do a debt consolidation loan, which is literally when you go to a credit union, a bank. We do this very often for our members. And you bring us the debt and you say, okay, I want to pay off these. We lend you a loan, and it's typically for 5 to 7 years repayment. And we pay off those debts on your behalf. And now you owe, instead of owing 4 or 5 different companies, you owe us a debt consolidation loan. Typically, with debt consolidation loans and our personal loans, I think right now they're at 4.99, but typically the benefit and why people tend to do that is that it gives you more time. So you spread that over 5 years. Now you might think, okay, 5 years, that's a long time. I want to be done sooner. That's why you always want to check. Are there prepayment penalties? For the most part, there aren't. For us, there are not. I want to be very specific. For us at the credit union, there are no prepayment penalties. But check with your financial institution. Most financial institutions won't have that. So if you get a bonus, a promotion, a raise, you are able to apply additional funds to those loans to pay that off sooner. Sometimes people will do the longer repayment term to give themselves flexibility. So if you want to give yourself a little bit more wiggle room in your budget, extending the repayments will give you a lower monthly payment. However, I do recommend if you're going to give yourself that wiggle room, apply those funds to something else. So maybe you're putting those funds towards a savings account. Maybe you're putting those funds towards the debt, even though you don't technically, you're paying more than what you need to, just so that, just like Sarah showed, that little bit does go a long way. And then there are refinancing loans like that are specifically that. It's, I have a mortgage with company A, and then I want to go to mortgage with a company B because company B is going to give me a lower rate. There are sometimes with mortgages, closing costs and other costs that are associated. There are mortgage loan originators, and we're actually doing a home buying presentation, I believe in 2 weeks, which we'll talk a little bit about that and what to consider. But there are organizations that, the part of the organizations that you would refinance with, they can help you understand the cost of it and when does it make sense and when doesn't it. Auto refinancing is very popular. This is something that you don't have to something that I wasn't aware of, and I know a lot of people aren't, is if I purchase a car with a car dealer and I get the financing with them, I don't have to stick to that. I don't have to stick to that with the life of the loan, especially if I bought a car a couple years ago. At this point, the rates are so much lower. So you may want to look into refinancing. Student loan refinancing, we just don't recommend doing that right now. With student loan refinancing, it if you have federal student loans, they're at 0% through January. And if you do have private student loans, we don't quite know what the market's going to be in the next couple of months, so it may be worth waiting and seeing. But it also depends how much debt you have. If for student loans, it's a lot trickier, truthfully. On our YouTube channel, we have a good amount of student loan presentations, and we also on our blog have a couple articles as well. And then the famous credit card balance transfer. So this one is when you have credit card with a credit card balance with company A. Let's say I owe $10,000 with company A, it's at 18%. That's a balance that it may take me a significant amount of time to pay that off at that 18%. Company B, credit card company B, may offer me to take the debt from company A, and now I owe it to company B at 0%. And that sounds like, wait, that's a great rate. Now I'm going to be 0%. That's awesome. And yes, that's really good. This is where knowing our money personalities, knowing our goals, knowing our budget. If I do that balance transfer, I should go into it with a plan. Okay, it's going to be 0% for a month, excuse me, for 12 years, sorry, for 12 months, a year. And if it's going to be 0%, I'm going to calculate how much do I have to pay every month. At $10,000, that's a significant amount. I may not be able to do that. So maybe I can't pay that full credit card in that year, but what I can do is pay a significant amount of it. I can also not use the credit card for major purchases, or use it just for something that is a monthly need, such as an electric bill or a subscription account, and pay that off in full every month. With the credit card balance transfer, sometimes some of the things that we've seen and why sometimes it's not successful is that we discount the future. We think, I'll be able to get it done. This is just human behavior. We'll all do it. And we think, okay, in a year, I have enough time. I have a year to pay that off. Oh, I'll deal with that next month. And, it's almost December. Like, we're almost at the end of the year. And I don't know about you, but I definitely feel like, what happened to the year? How did it go by so fast? So that's something to be aware of with the credit card balance transfers. Going into it, have the plan, be aware too that there is typically a transfer fee. So they may not charge you interest rate, but they may charge you 3%. They may charge you 5%. So you also want to know what that number is and want to have that paid ahead of time. So it's one less cost for you in the future. And then there are times that, yes, we gave a good amount of options, but sometimes the debt that we have, it just may not be doable. It just, I looked at my budget. I just can't do that. My rates are too high. So there are other options. And one of those options are debt management plans. And we have a good amount of members that take advantage of these debt management plans. It's not for everyone. I would say this is sort of, if you go through all the other options and it doesn't, and the other ones don't seem as to work, this is a good option to look into. So what exactly is a debt management plan? I like to start with what it's not. It's not a debt settlement. So if I owe $10,000, I'm going to pay off that $10,000, but I'm going to work with a nonprofit organization to essentially create a plan based off of the debts that I have so that my interest rates are lower. So that company, in our case, we work with GreenPath, they work with major credit card companies and lenders across the country. So they might say, okay, Migdalia has $5,000 with company B, and company B told GreenPath, okay, yeah, she has $5,000. You can bring the rate down to 3%. So my 18 can drop to 3%. Sometimes it's not as drastic. Sometimes it might be only a couple percentage points, but that reduction in interest rate helps more of our payment go towards the principal, which is what we always want. So they're able to reduce that interest rate. They're the middle person, so you're not having to do that communication. There is financial counseling that's part of this, and there is a cost associated with this. Every state is different. I know we have some folks from a couple of different states. In Mass, it's $10 per account, but the maximum is $75 in Mass. So that if I have 8 accounts or 8 different debts on this plan, I wouldn't pay $80. I would pay 75. It doesn't always make sense for everyone, but we do want to just give you the numbers. And here you'll see in this example, this actually was an example that we have from an actual member. But this member, they were paying monthly. $573 was going just towards interest. And this is where that debt starts to get to us, where, that's a lot of money. That's a lot of money that we're just paying that's going towards interest. Like it's not even hitting that principal. They called GreenPath Financial Wellness. It's a free call. They walk you through the program. They essentially run these numbers on your behalf. And they were able to reduce how much interest that individuals was being charged. In this case, they had 5 accounts. So that's where the $50 is, the service fee. But the benefit, the savings was that $408 was going towards the principal payment, where before it was not. So in this case, it definitely helped. And we've had our members pay a significant amount on these plans, and you have the monthly counseling. So it's something to consider. Again, not for everyone, but it is another option. And I did mention GreenPass, so here is their contact information. And this is available to all of you, even if you're not members of the credit union. So yes, you're all eligible to be members of the credit union. We would love to have you a part of our organization. And your family is also eligible. That includes your parents, grandparents, children, and siblings. But if you don't have a financial need, we completely respect that, but we want to make this available to everyone. So you can still call GreenPath even if you're not a member. You do have to mention us at the credit union, but that's just for them to track. They don't share your information with us, and we don't look at that specific information. I know we went through a lot of different things, and we have we allotted a lot of time for questions. But before I'm going to go through, actually, I'll go through the next steps fairly quickly, and then I'm going to turn it over to Wendy, who is from your workforce office, and she'll tell you a little bit more about additional resources that you have through Children's. But just a couple of different things. I hope all of you have pen and paper, or if you're on your computer or on your phone, just open up a notepad, send yourself an email, and what will your next action be? Like, what are you going to do? What are your next steps? I'd love it for some of you maybe to share. I'm not going to say your name, but just share in the questions. What are some of your next steps? What are some things that you will do after this presentation? Like for some of us, it may be, I'm going to actually look up my interest rate. I'm going to calculate how much interest I'm going to pay if I continue on this current payment plan. For some, it may be calling GreenPath. So if you wouldn't mind, let us know in the questions panel. What would your next step be? What are some things you would do? And then continue to stay informed. It is hard to stay motivated. I think part of this, keep in mind that sometimes it's going to be hard. We're going to have a month that it might be a setback, and just keep in mind that it's just 1 month. Next month you can continue going and continue moving forward. We do have a couple of additional slides that I'm going to go through, but before I go on to those slides, I do want to turn it over to Wendy, who has some information. That way, I allow time for questions. And I do see some questions that are coming in. I see some comments. So please keep those coming. I'll turn it over to Wendy, and then I'll go and answer some of those questions that have come in.
Hi, thank you, Magdalia. Good afternoon, everyone, and thank you for joining us on this info session. This is one of four info sessions that we have set up with our new partners, and this is an initiative from Benefits and HR to just support our employees in some other different ways that just on their career here at Children's, but implementing our well-being at Boston Children's, which has extended some of our partners to have more options for our employees in the health and the financial side of our lives. And this workshop is one example of those we want to create, just new ways and informational sessions to try to guide our employees in different areas of their life and try to help, with the improvement of some of the benefits that we have available. So we hope that this info session has been helpful to you. There are different areas that we will be covering in the info sessions, and as well, they will be recorded and available after on the page that you've registered. So you could share that with other folks that might learn from these sessions. Thank you very much again. And if you have any questions, please connect with us, with the benefits team, and all of the information for some of our new partners and the registrations. They are all under our Web2 internal page for Boston Children's under Human Resources in the benefit side. So please go there and take a look. We have a few new things for this year, and we hope that you are able to take advantage of those, and also some discounts on many different things that we have there. Thank you very much to Sarah and Midalia for this great presentation, and I'll be here. Thank you.